I guess, Patrick, in a universe where you do see some opportunities, talk about the basket that we should be eyeing right now.
Well, I think you're absolutely right. I think the opportunities are in the low value names, given the more favorable valuation. And earlier you cited low P, and I think that's where investors should be placing their focus. I think what has happened over the past 12 to 18 months is investors have really taken a very close look at the secular growth themes. And as a result, those companies have gotten very expensive. They're primarily in the software sector, other portions of the market that are showing very strong innovation. Investors naturally gravitate toward that, and they look quite expensive. And right now, with the Fed raising rates, investors are paying close attention to how higher interest rates are going to affect the discount rate. And that's causing a lot of those names to significantly underperform. So as a result, we're looking for investors to move towards the cheaper names in the benchmark as a way to find opportunities there for good companies, but also then to maybe get that valuation support that you're not getting for some of those more expensive names.
Right. So does it matter if they're low PE growth versus low PE value? And also, does it matter if it's low PE US or low PE ex-US?
I think the word you use there in every example is low PE. I think that's what's most important. And when you look at this recent sell-off, typically quality companies do very well in a market pullback. This time, quality companies are also underperforming in addition to growth. So what investors are doing is they're simply taking a look at their portfolio, really sorting their portfolio high to low on PE, and they're selling the expensive names and they're buying the cheaper names. And it's as simple as that. It's almost a single criteria which many investors are looking at. It's unusual to see that happening. And we would really encourage investors to kind of lean into that approach, given the concerns around higher interest rates.
Patrick, is that a short-term trade, though? If you're in it for the long run, what do you make of Cathie Wood's argument that she made yesterday? Looking for value this way is backward, that you have to look for companies that are innovating, that are sacrificing the E earnings for innovation and growth in the future.
So I agree with Cathie. I think you want to find innovation. I think the question is, what are you willing to pay for that innovation? Right now, paying for that innovation is extremely expensive. If you take a look out over a 5 or 10-year time horizon, you can afford to make that investment for innovation because likely that earnings will come through for the winners. I think right now, though, for the next 12 to 18 months, I think valuations are a primary consideration for lots of investors. And given the spread, how expensive those companies are, those really expensive companies, that gap has a long way to close. So there's a lot of opportunity in those cheaper names. And frankly, they're good companies. You mentioned earlier, a lot of them are paying dividends. There's a lot of good opportunities within those names.